Good evening, everyone. Our today's topic of discussion is understanding alternate investment in real estate sector. Today we have with us Mr. Navin Dhanuka. I'll give you a quick background about him. He comes with almost 20 years plus experience in real estate investment space. He started his career in Ernst & Young EY, where he led the practices for setting up the real estate vertical for them. Post that, he joined a US-based private equity fund called as Walton Street Capital, where he was leading investments for India. After that, he joined Piramal Capital during its initial days, where he led the investments for entire South India and hospitality on a pan-India basis. In Piramal, he was part of the core strategic team, and he increased the AUM from a $50 million to almost $8 billion. And he himself was managing a book of close to $2 billion there. Post Piramal, he has started his own real estate practice, which is into consulting and investment space. So we have Mr. Navin Dhanuka to discuss these topics today with us. Thank you, Navin, for joining us.
Thank you, Vineet. Good evening, everyone.
So the way we will structure, Navin, the discussion is that I'll be asking you a couple of questions, and then you can tell us more about real estate. And then at the end of the session, we will have a Q&A session where our attendees can ask us questions. I'll request all the attendees to please type in your queries in the Q&A box or in the chat box, and we will take up one by one all the queries and we'll try and answer them.
Perfect.
Okay.
Sure.
So we'll start with a very basic question in real estate is that when we talk of real estate, it sounds like a big word. But if you can just simplify it for us, what are the various asset classes in real estate?
So traditionally, there are 3 to 4 asset classes to real estate. We talk about residential, commercial. Commercial can be further fragmented into commercial office space, retail space. Thirdly, we have hospitality or hotels, hospitals. Now, industrial has taken a big way into that, which considers of factories and various places. And then especially South, Bangalore, Hyderabad, Chennai, we see there's a segment of plotted development, which is again a very traditional product, but yes, it continues. So these are the major asset classes again of, if I have to say, of real estate. However, for a retail today, there are multiple subcategories of asset class which has come into. This is more for development of IT and how there have been globalization of movement of people. So today you have co-living, co-working, managed offices. So those are other new subcategories of real estate which are there. But if I have to again put it into broad, just to summarize again, it will be residential, commercial, industrial, and plotted.
Okay. So no, thanks for summarizing it for us. Now, if I have to take the next step, what are the various investment options that any investor has in real estate space?
So again, let's look back at history. Historically, people were mainly buying into lands or plots. The title was also much easier if you're looking 15, 20 years back. Especially in South India, there is the main 2 investments, what we keep talking about, land and gold. They wanted the land below them and the sun above them. Subsequent, they were either building apartments or something in it and either giving it when the children were getting married or inheritance. Subsequently, it further grew again into buying apartments, shops, or office spaces for rental. Today, there are better or more opportunities of investing into real estate, more professional, if I have to say, with Embassy REIT coming up as the first real estate-based REIT in India, where you can buy units of completed rented office spaces. Subsequently, with the digitization and everything's coming, now there are a number of platforms, PropShare, Starter, etc., offering fragmented ownership of commercial office space. And subsequently, now there are certain recent startups which have also started fragmented ownership of residential units. where you are in both the things, you are getting basically some kind of an annuity return and expecting an capital appreciation of it.
Understood. So
And
if I have to just,
if I can add, so sorry, but if I can add
please.
now, but what all we are talking about again, most of the above which I've spoken to you about is all more equity slash quasi equity kind of a investment. Now, like platform like yours and coming up, also they are offering within real estate alternate investment fixed income opportunities, which again is more democratized, where real estate being the base, you have an ability to invest in real estate and earn fixed income group for a finite period. So these are the new opportunities which are coming up. I think there will be more to come.
Okay. So just to summarize what you said is that traditionally the investment option was that you buy a property. It will be either in the form of land or building. The nature could be either residential, commercial, shop, etc.
Yes.
Now with REIT, you can have an exposure in real estate, which is basically commercial real estate, where you buy some units of the REIT. Then you have certain options where you can buy fractional real estate, like you, as you mentioned, a couple of platforms which are giving the options. And then you mentioned that there are some platform like ours which are giving debt options in real estate, right? So these are the broad spectrum of investment in real estate, right?
Yes, and it is a natural course of growth also, or the value chain, because the problem was we are buying land or building. It used to go either the ticket size are very high in the current market, or you are troublesome in getting the clear title. Very difficult as an individual to manage title. If someone takes possession of your property, if your property gets empty, then how to lease out the property? Because most of these investors have their own set of businesses which they are doing it. So it is not their core business to manage such properties. So now, earlier with the embassy REIT coming, where it is a professionally managed, or the fragmented coming, now Jiraaf coming in on the debt side, it is professionally managed investments where an individual doesn't have to take the pain of managing the maintenance or leasing or marketing the product or any problem coming in. That is being taken care of by the professionals. So that is and that is only improving. So that is the normal growth process of the investments which is happening for the individuals out there.
So like you mentioned in the last point as well, in the traditional form of real estate, or in REIT or even in fractional ownership, you are taking an equity position.
Correct.
Okay? And say the other platforms, say like ours, are providing you debt options. So
Correct.
now with equity and with debt, there are different risks associated with both these form of investments. So
Absolutely.
Can we talk about what those risks are in equity type of an investment in real estate and in debt type of an investment in real estate?
See, investment is always more individualistic, and each one has its own risk appetite and risk or investment thesis. So both are right, and both will have its pros and cons. So today, as I said, let's take for example fragmented ownership of commercial real assets. The good part about that, someone wants to have the satisfaction of ownership, they're getting to a certain extent. They're getting an annuity return of typically between 5 to 7%. Ticket size can be small to big depending upon the transaction. The issue remains that it is too much driven on external factors like interest rate compression, yield compression, to expect a capital appreciation to happen. It can go either ways. So it may go up and you may get at overall a 12 to even 20% return, or it may go down and you may start losing equity on it. Though you may be getting the annuity, but on an overall basis, you may be even having a negative return on it. Whereas when we talk about, and again, a lot of times your exit period is undefined. Again, your exit itself may be undefined because you don't know how to exit it if you require the money, and your major return comes only when you sell the units.
And especially this is again if you are taking some under construction exposure and all. So it
yes, so most of this fragmented as of now are avoiding under construction risk. Some of them have gone, but that's a challenge. So I don't think most of the cautious investors will go under construction units. The whole the thesis of such transaction was to have safe yield assets only, which are already hard rented. But the problem remains that, if it gets empty, then you need to lease it out. There has to be a proper management, maintenance has to be done. A lot of these people who are buying, they are not buying the whole building. It is a fragmented purchase from there and also, or startup purchase as we call it. So that may have a toll on the maintenance of the building. They may have to maintain the building. So there will be more hidden cost, if I have to say, or other costs like huge asset management fees and other market driven issues which may come into place. But at the same time, as I said, it has its own strength and weaknesses. As far as a platform like yourself, which is providing debt transactions, the good part is you can do into ticket sizes between 1 lakh above comfortably. You know on what asset you are putting, the finite period under which and when are you getting your returns. With assuming good security being mentioned, being there is a good buffer. Even if market moves by 10 to 20%, your return remains secured and finite. And you know how your exit is happening. You can plan out. So those are the advantages which you are taking. If I have to consider a little bit on the disadvantage side, see again, though it is a debt play, now the only way your investors' money cannot come back is if there's a huge legal problem which comes on the project, which I think is mostly underwritten by the investors, or the borrower itself gets bankrupt. So the probability, considering it is again professionally managed and underwritten, the probability of that happening is very, very low. Whereas against, if I have to look at the probability of an interest compression or a yield compression, I'm a math guy, so I look at more at the probability part of it. But on the other hand, but you are also underwriting a business risk being overlooked by professional people. So on a risk adjusted basis, I'll put my money more on the debt than equity because I do not have much of a say there. So that is how I look at it. But again, as I said, it is more individualistic at any point of time.
So it's basically what you're saying is that in debt investment, the component of variability is not there, which is there in case of an equity investment. And
yeah, relatively it is much lower.
Yeah, and since it has been since you will have securities, etc., you have a higher probability of estimating what exactly you are entering and what exactly you will get.
Exactly. See, that's the nature. In an equity, even in fragmented, you are getting a very low annuity return, and most of your return are based on other external variables, which may go high or you may even lose the money. See, a typical middle class investor wants to always safeguard the capital at least and then look forward. So from that point of view, a debt transactions where what is the kind of return, the chance of variability on your return is very, very low. With high security, your capital is, at least let's assume, is very, very carefully protected, and the chances of when you can plan as a middle class man, you want to plan when your cash flows are coming. So the planning is much more better because that when your cash flows, when your interest is going to come and your principal is going to come. So from that way, the planning is much better.
Understood. Also, just talking about the entry barrier. Okay. So now in terms of all these products which are, where you need to buy something, you have a slightly higher entry barrier. So what is the kind of investment amount required to do an equity play and then to do a debt play as per you? From an investor's perspective, yeah.
So again, different categories of it. Now, if I'm going to buy if I go by the traditional way of buying a land or an apartment, land is kind of out of question now. As the world has grown, getting clear title land by an individual becomes very, very tough. Especially I'm talking about a middle to upper middle class. When you are going to buy large tracts, then you have the time, effort, and money you can spend on clearing the title and getting it. For a typical middle class, where I'm saying a typical middle class, I believe, have a floating money between 1 lakh to 1 crore. Okay. So how the way I look at it, I'm just going a little probably digressing. The way I look at it, most of these people first put their money lies in the saving account. A lot of people don't even notice. Then it goes into part of it into the FD account. they have a little more money, the little more savvy, they put into liquid funds. Then it goes to friends and family, which the principal may not come back. Then if a higher ticket size, today, then they try to buy the properties. But today, buying a clear property, maintaining, management, leasing is a very, very difficult task. That is where more sophisticated, professionally managed, digitally managed platforms have come, whether it is your fragmented ownership or your platforms like Jiraaf, which are offering debt transactions in real estate. Now, the problem remains there that if you're trying to buy a property, you may have to spend 1 crore to 10 crore to buy a good quality asset today. Whereas what these platforms are providing is they are democratizing the investment in a professionally managed way, where they are putting the 10 crores or the 20 crores and providing the units, smaller units of 1 lakh to 10 lakh rupees to investors, so that a middle class and upper middle class investor can also buy a high quality, a grade A quality real estate, or invest directly or indirectly in those real estate and earn the money, where the title, management, everything is clear through this professionally managed. That remains more or less same for the digital platforms where we are offering fragmented, or platform like yours, which is Jiraaf. The main difference there goes that those are more equity kind of deals, which we have again spoken about, and people like Jiraaf is offering more debt transactions, less variable transactions with fixed return, fixed period things. That's the main difference.
And now, if I have to talk about, thanks for explaining the risks of these products to us. If I have to talk about return expectation now from an investor perspective, as an investor, what should be my return expectation if I'm doing this equity level investment across these products, or if I'm doing a debt level investment, in the real estate space?
So again, I'm talking about more from a middle and upper middle class kind of a family. Now, for them to invest into high ticket size apartments and commercial, today fragmented is something which is non-recommendable, because residential purchase gives you a 2 to 3% annual yield, and you don't know when your capital appreciation will happen, not happen, and a high ticket size goes into it. And lot of those developers, you don't know whether the delivery will happen, when it will happen. On fragmented purchase equity investment, again, most of these people see, because you are at the higher end of the value chain, where the building is completed and leased out, most of it is already kind of top priced out. So the return available on an annuity basis, again, as we discussed earlier, remains typically on a residential. Most of the fragmented are offering 2 to 5%. On commercial, it will be between 5 to 7%, and the upside is completely equity linked or market linked. Whereas in debt today, what you are doing with a professionally managed company, you are writing the business risk, but with high security cover, and you can make between 12 to 18% return depending on the transaction you do. So that is where the return expectation has to be different between debt and equity.
Okay. But okay, so if I have to just summarize, you are saying equity, my return today the market is such that we get somewhere between 2 to 10% kind of a return, and in debt we are getting somewhere between 12 to 18% kind of a return. Okay, that's how the market is today, right? Now, but it sounds very counterintuitive to me, because generally, if you are taking an equity risk, you should get more return. If you are taking a debt risk, you should get less return. Why is it this anomaly in the real estate space?
So it is actually not counterintuitive. What we are talking about, 2 to 10% is kind of a short kind of a return which you are making on a year-to-year basis. The most of these people who will be marketing you, they will market you between 15 to 25% return, where they will be underwriting interest compression, price increase, residential buyback. So the expectations given or envisaged to a retail investor in such will be between 15 to 25%, where a 2 to 7%, not even 10%, or 2 to 8% is kind of a given return on an annual basis. Okay. Rest is a pick, which will be between 15 to 25 expected. However, what we and also most of these products, what we, as I said before, is we are talking about residential. Most of the people who are offering fragmented are at a very early stage, so far more risky. But on a commercial, what when we are talking about, again, we are talking about a completed leased out property. So the pricing is already maxed out. We are now further expecting a better improvement, and that is where we are looking at an equity return. Whereas when we are talking about the debt transaction, even transactions which have been offered by yourself in Jiraaf, what I have looked at is, based on whether you are giving a construction finance or see, most of the products which we are looking, I believe still plotted remains the most comfortable segment. Once your land purchase has happened and has been title verified, the development and the sales risk have been very, very low, as been seen traditionally. Land price increase have been, if you look at it, last 15 years have been on a base 17% on a YOY basis. Today, if you look at the best example today, Mr. Bill Gates, who has once become the richest guy in the world selling software and Microsoft, he is the largest real estate owner in entire United States. I don't know if you know that. Yeah. And as Mark Twain sometimes said, that if you want to invest, buy in land, because that is something which cannot be produced. And there have been movies made on Superman on that. That's a different story. But on a debt transaction, what you are writing is a business risk with professionally managed company with high security, with your most of the title done by high quality professionals, lawyers, CBREs of the world. So with that, you are, because of the business underwriting, you are making between 12 to 18% on a high security cover. So that is the difference, but it is fixed. You are not stating that you can make a 15 to 25%, which may actually be positive, which may actually be negative. So here, I think you have to compare 12 to 18 to 15 to 25 and not 2 to 10. That is the main difference between the equity and debt when we are talking about.
Understood. Now, just from an investor's perspective, which are the top 2-3 types of project that you would suggest, given your vast experience in real estate space, from an investment perspective, be it equity or be it debt? Which type of projects they should look at? I mean,
again, as I said, it was always it is
yeah. Why I'm asking you this question is I'm asking from a retail investor who is not very savvy, who doesn't understand the nuances of real estate. So then what type of products or projects would you recommend?
See, if someone, a retail investor putting between 1 to 10 lakh rupees,
okay,
but ready to take, has a good risk appetite, they may always go for fragmented purchase. If that is giving them a feeling of ownership also. However, as I said, most middle class families in India, we are building the money. The last thing we want to do is lose money. That is, our asset protection is more important. Today, why LIC, though it commands the highest premium, is still more preferred than most of the other insurance companies, is because people believe the claim will come and the claim percentage is very, very high. Similarly, for an individual who's putting 1 to 10 lakh rupees, it is their hard-earned money, and they do. It cannot be called disposable money. So from that perspective, first thing they should be looking at is asset protection and more of fixed return than going for the pick. So today I will still recommend that if you can put money in a professionally managed fixed return, fixed period transactions, that is much better. And ultimately we call real estate because it has an asset cover. Today, when we are looking about those retransactions or fragmented, you are maxed out again on the pricing. So there is no cover. You are at 100%, you are looking if it will improve or decrease. It is like still like buying a share at 100% value, right? Whereas in debt transaction, you are typically between at a loan to value, you are between 50 to maybe 40 to 60%. typically I'm assuming when people like Jiraaf are doing, they'll be doing between 40 to 50% LTV or more than 2 times cover. So there is a cushion available, comfortable cushion is available, that even with small shocks, the return and also more importantly, the capital of the investor will remain very, very intact. So if you can invest for a finite period with enough security cover, professionally managed, where without asking and without dunning, your interest and principal is coming into your account, I'll prefer that than going into the equity. Again, focus.
And what type of projects we want to
Yes.
understand also?
So
What
that
type
was
of
my next. So going into that also today, as I said before, that land remains the most precious. It has a, it always appreciates. So indirectly, if I can put in plotted development where my approval risk is very low, my execution risk is low, as historically seen, demon, no demon, GST, no GST, plotted has continuously across various cities have done well. So plotted will remain, and it is between 1 to 3 years of investment where you can easily exit, or last mile funding where again your covers are high, you are not taking approval risk, sale price is underwritten, construction to a certain level is underwritten, so you know very clearly that within what period you can complete the project, sell and get out. That those two are my most preferred buckets into real estate transactions. Not go into very large projects because they have their own gestation period and sometimes the project gets tired out. So small projects, plotted, last mile funding. Those is my recommendation where I'll put my money on.
Understood. And just last question from my end is just from a portfolio perspective. If you talk about, as you mentioned this briefly in your talk also, is that everybody will have some saving money, some FD, some SIPs, equity, and maybe they will have a house for themselves. Apart from this portfolio, if somebody wants to invest on a portfolio level in some of these instruments, like be it fractional real estate, be it debt investment, what's that portfolio size would you recommend? And will that and because you mentioned the return also, which is upwards of like 12% or 14% plus, will that portfolio allocation help them in making it extra delta? Have you seen that in your journey or in your career?
So going back to that 1 lakh to 1 crore concept which I told you, see, ultimately everyone first is, yes, you need to have, and buying a house, your own house is more of an emotional assurance to each Indian family, and we still remains so that is important. But outside that, today you need to keep some emergency money, which may be between 1 lakh to 5 lakh, depending upon again the family size and their lifestyle. But post that, I don't know if most of the people who are hearing us also understand that even a FD in a bank is assured by government up to 5 lakh rupees. Beyond that, it is not even, though it is fixed deposit, even government is not backing your FD. If something happens, and we have seen some of those cases, whether it is DHFL or some of the other banks going down right now, PMC Bank, Cooperative Bank, etc. Those are not fully protected. Whereas the returns which you are getting on that may be between 4 to 6%. So better than that, if you can take your own call and put money into, today some of the platforms are offering between 12 to 10 to 12% bill discounting or higher return professionally managed transactions. Today our inflation rates have grown up and it is close to 7-8%. So by a right mix, if at least 30% of your those allocation you can put into those 10 to 16% transactions, but debt where your principal is more or less protected. That is the kind of bucket you should go out, and a good portion of it real estate with see, ultimately others are ideas. Real estate has a strong security in terms of flat or building. That should be about 20 to 25% of your investment indirectly. If you can do that, I think you will be above the inflation rate. That has to be your target ultimately.
Yeah. So I'll end this session with something you started with, is that I think India as a country is maturing. Financial products that are available to Indian citizens today are maturing over the years. As you mentioned, in real estate, started from buying land to making our own houses, then to buying apartments, shops, etc., commercial, and today we have the likes of REIT, fractional real estate, corporate debt investments, etc. Is a journey that the country is taking, and hopefully, in the next decade or so, we will be coming out with products for retail investors, like any developed economy in the world.
Best of luck for that. And I think we really need that because, we need to grow above unsecured, fragmented investments to more secured investment. That is very, very important for the middle class. And we have the best digital capability in the world. I'm sure a lot of listeners would already know that our digital payments are more than 2 times of China. Most of the Americans who come to India are surprised that even a sabji wala has a barcode on its thela. So
Yeah.
we are leading in the digital world, and there is no reason we should use it in our day-to-day investments also.
Great. So thank you, Naveen, for the for the knowledge that you have given to all of us. What I will do is that we can open the house for Q&A, and we can start taking one by one. I'll read out the questions. If it is something which pertains to Jiraaf, then I will answer that. If it is something which pertains to industry, I'll request your views on the same.
Sure.
Okay. So one question is from Mr. Abhishek Kumar. He has asked, how are we ensuring the security of real estate investment on Jiraaf? So any deal that in real estate that we bring on our platform, Abhishek, okay, we do proper due diligence. There are 3-4 level of due diligence for any real estate transaction. First is the land due diligence or the title due diligence. For that we employ some of the top law firms in the country that they do it for us. Only once we get a clear title, that the title of the particular property is clear and marketable, then we take a call on the property. After this, we do a valuation of that said property. Again, this is being done by one of the top IPCs, which are like Fortune 500 companies with the likes of CBRE or JLL. They tell us what the value of the land is. We don't empanel any bank valuer. Okay. Third thing that we do is that we do a technical due diligence. If it's a development property where any development or approval needs to be done, we do a technical due diligence. Again, the technical due diligence is either done by one of the top IPCs, or there are some very specific, very renowned due diligence agencies. We employ them. After we have done all these due diligence, then we do the credit assessment. Once the credit assessment is passed, the security structure for any real estate transaction is that we take mortgage over the entire property. We take hypothecation or escrow of the entire receivables from the project. In most of the cases, we will take the personal guarantee of the promoters. And in case of any holding structure, we will also take corporate guarantee. Apart from all these four, we also take undated checks and post-dated checks as a part of our overall security. So this is how we ensure that a proper due diligence process is done by third-party consultants, which are renowned. We ensure that a proper process of credit assessment is done at our end. Then we ensure that a proper security package is structured while doing any transaction.
So Vineet, if I can add to it.
Yeah, please.
Basically, and since I'm also an investor in Jiraaf and we've gone through it. So basically, Jiraaf is following the same process which any international bank or a private bank or a NBFC or any reputed institutional lender would be doing to secure their transactions, and following the same method of business underwriting and security mortgage, which is done by any one of them. The only difference is that the same security, if an individual was going, they may not have the capability to negotiate for their few lakhs with a promoter who wants 10 crores. Jiraaf, by putting that 10 crores, is being able to negotiate the same security or a better security than any institution or NBFC will be able to negotiate with the developer and create similar kind of a diligence and security process. If I can just put it, summarize it in that way.
Yeah, one more last point which I missed is that Yeah, for the one more point in this, Abhishek, is that we also have a trustee in all our transaction. It's a third party trustee. This trustee basically represents all the investors of Jiraaf for real estate in case of any default scenario, or in case of day-to-day regular operations also. So that
And
is,
all the security is pari passu to all investors. I think we can go to the next question.
yeah. So next question is from Mr. Rajesh Mishra. He has asked, if I have 10 lakhs to invest in RE, should I buy one debt product or should I split into 2 to 3 debt products to reduce the risk? I think it's a very straightforward, Rajesh ji.
You should
I
always
think
diversify.
you should always diversify and reduce the risk. We would recommend you to invest across multiple products. Another question we have is from Mr. Lohit. He has asked, if I have 50 lakhs, what is your advice on investment? I think, Mr. Lohit, we have to take this offline, because we cannot like recommend you as to how this 50 lakh you should invest without understanding the profile, requirement, age, etc. If you can be more specific or can provide more detail, maybe we'll be in a position to answer this for you.
Because again, it, as we continuously said, it's more individualistic. For what time frame you want to put, what is your risk appetite? Some people want more multiple, versus some people want more monthly and quarterly kind of a return. So once we understand your risk profile and your risk appetite, and what do you want, then it will be easier for us to recommend both in RE and non-RE what kind of transactions you can be investing in.
Next question I have from Mr. Manpreet Singh. He's asking, what type of security will be considered to mitigate the risk in real estate investment by Jiraaf? Sir, we have just answered this question. The follow-up question is what I will answer. What will be the tenor of these investments and whether the returns are monthly or at the end of the tenor? So, sir, typically the tenor of the real estate deals that we bring on our platform is between, I would say, 15 month to 24 month kind of a tenor. The return is generally quarterly in nature, not monthly, and with the ballooning payment at the end. This ensures that we have sufficient time for the project to start delivering in terms of cash flows, and this also ensures that all the investors, they get a decent multiple on their investment. Not only the IRR, they also get a good multiple at the end of their investment. So that is how we structure the transactions.
Yeah, but again, monthly and quarterly will be again based on the transaction. Last mile funding, money coming every day it will be more monthly. Longer period transactions will be more quarterly. That's how it will go. Next.
What factors do you consider as factors of safety during real estate curation process?
So if I can answer that, Vineet.
Yeah.
The first most important criteria in any transaction for us, especially real estate, is the counterparty. Okay. So our first understanding, diligence, background, track record, everything is of the counterparty. That is our first criteria. Once we have ticked off the counterparty, which is most important for us, then comes, as we discussed earlier in some of the questions, is to underwrite the project risk, market risk, pricing risk, execution risk, sales risk. All those are understood and underwritten. That's how we decide the risk adjusted return. And once that is done, that is how we issue the term sheet or agree on the terms of the transaction.
So question from Santosh ji is that, can you elaborate the last mile financing concept again?
Okay, so last mile financing means that a project which has approval, where the land has been purchased, approvals are in place, construction and sales both have happened, and maybe the project is between 50 to 70%, 80% completed. However, because of lack of money, delay in the project has been wanting more money to complete the project. So wherein we enter ensuring full financial closure of the project, where once we have put the money, You don't require additional sales or anything to complete the project. With our sold receivables and our money, there is 100% financial closure achieved on the project, and thereby you are not taking, because a half completed building is worse than a fully completed building, or there is no building, because it is in nowhere. So when we mean last mile funding, we stay advanced stage project, wherein with our money you achieve full financial closure, because once it is completed, it can be sold and you recover full money. That is what we mean by last mile funding, which has approval, sales, cost all underwritten. Approval.
We have another question from your same name, Naveen ji only, is that what is the taxation difference between an equity investment and a debt investment in real estate from an investor perspective?
Again, that is more to do with individual tax structuring, how you are doing. Both when you are taking an equity, a fragmented purchase, or buying a unit, the tax impact is going to be based on your personal income and how you are doing a tax structure.
But I think Naveen, in this equity, it will be like capital gains only, and in debt it will be like interest.
Not necessarily. Again, it can be considered. Again, you're not. It is again long term, short term is more to do with pure equity when you're doing in the market. When you are doing, it will come under other income. Most of it will come under other income. Same will be your interest income on your debt transaction, and depending upon your overall income, your tax bracket will be decided.
Okay.
On property sale and all, you would have chances of putting into real estate or something like that. Yeah. But it is again totally into individual tax structuring.
Okay. We have one more question again from Naveen ji, is that it's broadly basically what he's asking is that how many offering we will bring in this year, that I can answer. So what we are planning is that, we will be bringing somewhere between 10 to 20 crore of real estate investment opportunities every month now onwards. So for the year of 2023, we have a vision to do some. So we have say around 7 months left, 6-7 months left. So in next 7 months, we will do somewhere between 100 and 150 crore in the RE investment space through Jiraaf.
Based on availability of quality transactions, there will be no compromise on that, I'm assuming.
Yeah.
That's given. Yeah.
Yes. Again, this question is for me. It has been asked by Mr. Abhishek. Is that can someone exit in real estate investment on Jiraaf? Suppose a person is invested for 5 years and getting return and wishes to sell off his portion. In that scenario, will the investor get the principal plus the appreciated value of his holding? So there are two clarifications here, Mr. Abhishek, is that first, we don't do any transaction more than 3 years on our platform. Second, you will get principal plus interest. There is no appreciation in terms of value of the holding, basically. Okay, so because it's not an equity play. Third, we don't have a liquidity option which an investor can exercise during his investment phase, because these are debt products. That is what Mr. Naveen was mentioning. In debt, there is no variability. So you have basically invested for a fixed amount, for a fixed tenor, and for a fixed return, which has been told upfront, and you will get the return and exit accordingly. But the point to be noted here is that the way we structure the transaction is that you get certain portion of your principal back on a very regular frequency after the basic static moratorium period. It is not that you will get your entire principal, which is fully back-ended generally. So that's the difference.
The private sale can happen, but Jiraaf, I think at this moment, is not providing that facility. So on a private sale can happen. No one is stopping that, but that is not, Jiraaf cannot take the responsibility of it at the current stage.
Another question from Mr. Anup Menon. I'll answer this. Is Jiraaf planning to bring fractional real estate investment? What is the tentative date you are planning? As of now, we don't have any plans of bringing fractional real estate investment.
I think, Vineet, if you can elaborate on it. Right now, the focus of Jiraaf is not to compete with the PropShare, the startups on a thesis basis itself. You are more intended to be a fixed income debt platform compared to be prop share strata which are more equity based. So there is a thesis difference itself, at least at the current level.
Yeah. Then we have okay. Again, the question is from Abhishek: is that RBI has asked digital platform to comply with NBFC norms. How are you taking up this for compliance? So this is for the digital lending platforms that that the RBI has given this recent paper on, and it does not apply to Jiraaf as a platform. What Jiraaf does is basically, we subscribe to the debenture on the primary issue, and then we sell these debentures, downsell these debentures to our investors, and that is something which we use SEBI regulated instruments, and hence this is not applicable for Jiraaf as a platform, right?
If I can answer Abhishek in other words, that Jiraaf is neither taking deposits nor as a platform, it is lending to individuals or to corporates. So since neither it is lending or borrowing, it doesn't come under the purview of RBI. It is more of a marketplace to where it is making the borrowers and the issuers or the subscribers meet. So since it is a marketplace and not a lender, it doesn't come under the purview of RBI, which has been very well, I think, opinionated by some of the top lawyers and the RBI consultants of the country.
We have a question from Mr. Jinesh. Considering the default situation in real estate, as there can be issue of security enforcement due to litigation done by the borrower, how the structure addresses this? So, sir,
just if I can just take
you can take this question.
Yeah. So as we said that there is all kinds of security which is being done by any institution. Same kind of a security structure is being done by the Jiraaf, where you have a trustee to which the entire mortgage, hypothecation, personal guarantees, corporate guarantees, whatever best is possible is being taken. So again, there is a proper court enforcement process through which you will be enforcing the securities, or now you have personal NCLT enforcements which can happen. So whatever an institution can enforce in case of a default, the same kind of enforcements are available under the structure to enforce against a defaultee. And as you have seen in last few years, the government and the court have become very, very strict and have brought a lot of reforms to ensure quality enforcement of the securities.
We have a question from Sumit. Do you deduct TDS for the monthly income, how bank does? So for every interest payment, because these are debenture instruments, so for every interest that is getting paid against those debentures, TDS is being deducted. But
it is being deducted by the issuer, by the issuer or the borrower at source itself. Correct. And yeah, Jiraaf only facilitates that, but Jiraaf doesn't deduct anything.
We have a question from Mr. SP that if the deal covers a commercial property, will you ensure it is tenanted out with 5-year lock-in? So, sir, we are not doing commercial real estate leasing investment opportunities here at Jiraaf, as we discussed. So that is not a thesis for us right now.
So in case of LRDs of such commercially leased property, there are banks which will do LRDs at very low rate. And we are not doing, I think Jiraaf is not doing fragmented ownership structure. So this is not part under the purview of Jiraaf as on date.
We have a question from Mr. Ashish. US citizens, can they invest in these opportunities, but who are physically living in India with ordinary tax resident of India? So, sir, I'll have to consult because it's a very, very specific case. So generally, if I have to give you a generic answer, so NRIs or US citizen or expats, they cannot invest in debt instruments in India unless it is listed. But here your question is that if they have moved to India and are a tax resident of India, so that is a very specific question. Maybe we'll.
I think, yeah, I think if you can leave your email ID, then one of the RMs of Jiraaf can get in touch with you, understand the exact technicality of your status, and consult our panel guys and answer you back.
So there are a couple of questions on bill discounting. So since this is a session for real estate, we will not be addressing those questions in today's session. But we have noted these questions. We will send you a response for this. We have a questions from Miss Malika, if I'm right. So when is the first real estate debt or investment expected to be offered on Jiraaf? What is the approximate interest rate that will be offered? So we have already done the first debt investment way back in September. We did one more transaction 1 week back. In both these cases, in the first case, our interest rate was around 15%. In the second case, it was around 18%. We are coming up with 2 to 3 new real estate investment opportunities in next 30 days or so. One will go live next week, wherein the yield, wherein the IRR is around 16% with a coupon of around 15.25.
I think since I was since I was an investor in the first RED, I think it makes sense to also say that that got exited much before time. The entire principal and interest came in and came much before time.
What is the risk? Yeah, what is the risk with the equity structure? Okay, well, we have one question is that what is the risk associated with equity structure in fractional real estate investment? We have the underlying asset as a guarantee. Is that not a safety?
So the risk associated with fragmented purchase is as follows. So you have the ownership of the property. You have purchased the property at 100% value. You are getting, it is a rented property. So the good part is you'll be getting let's say between a 5 to 7% annuity return. If you want to sell the property because it's a fragmented purchase, there's a question at your exit period. B, again, there is no question, as we explained earlier during the interactive session with Vineet in the question answer, that you have purchased, the purchase is happening at 100% value. There is not much of a cushion available to it. So you are exposed to the market conditions of your lessee stepping out, or your interest rate, like we are in an interest rate increasing regime, and therefore your yield rates may also go up. So the property value may go down. You may not, your property value will never become zero. You will be very close to your property value, but your returns can go up from 5 to 7% to 15%, or may remain stagnant at 5 to 7%, or because of decrease in capital value, because of increase in yield rate or interest, the overall return may even go negative. You will never lose a significant part of your value. That is the advantage which you'll have. It may from 100 may go to 90, 95%. You will not go below that ever. But A, as I said again, just to repeat, your exit period is not defined. B, your return is not assured. It can be plus, it can be minus. That's the risk which you are running.
We have this last question, is that can an investor in real estate NCD via Jiraaf get access to the document such as title deed valuation report of the company, so that it could help the investor to get more info? So Mr. Gaurav, what we can do from our end is you will provide you snapshot of these, but we generally don't prefer circulating all these documents across the investor, because then that creates different level of issues for us. But from our end, we are more than happy to show it to you over a call, and you can understand more about it. If you want a sort of a certificate from these agencies where we have whom we have appointed to do this due diligence for us, we can get some certificates, and that is something that we can share it with everyone. So I think we have answered all the questions, Naveen. Thank you very much again for coming for this call and telling us more about real estate. I would like to also thank all the attendees who took out time and attended this session. You can please feel free to reach out to us over an email. If you have any more queries, we will definitely respond to those queries from our end. Thank you again.
Thank you, Vineet, for inviting me up, and thank you for all the participants for hearing out patiently. Good night.
Good night. Good night, everyone. Thank you.